Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focus Compounding. Sitting next to the Geoff Gannon. That is hashtag GEOFF on Twitter. How are you doing today?
I'm good. How are you doing?
I'm doing great. This is the number one value investing podcast in the world with the number one value investing podcast listeners in the world. We hope everyone is having a great day. If you're watching us on YouTube, hit that subscribe button, thumbs this video up. We're trying to make that YouTube algorithm take us to great heights. If you're listening to us on the podcast side of things, we're over 200, by the way. I told you we were going to forget to celebrate 200, but we have over 200 podcasts up, which is insane. And it's a lot of fun because people listen. And when we get comments and feedback, that just makes all that much better. So a rating review goes a long way for Geoff and myself. Geoff doesn't check them, but I do, if that helps. And if you want to support us and you sign up at quickfs.net, tell them that you heard of them from Focus Compounding. If you have a membership and you have signed up for us, I'm not going to advise you to do this, but you know, you want to support us. I'm not going to say what to do, but you know what to do. Cancel that membership, re-sign up, click Focus Compounding. We love the website. And if the founder's listening, I'm sorry. In today's video, we are going to be going over how to think about intrinsic value in a recession.
Okay.
You recently said that you are the most bearish you've ever been on the market in your investing career. But that doesn't mean that we're not buying stocks.
Okay.
That doesn't mean that we, will continue to buy more stocks. We've done some transactions. We've also purchased more stocks. So let's talk about it, right? And I think you drew that conclusion from, and we talked about this in the Q&A in the last podcast we did, from some macro factors, but also from a lot of the companies that you've been analyzing, right? We're down, as we recorded today, 12% on the year, which is nothing, especially from the perspective of what the market did last year. So let's talk about it. How are you thinking about valuation and intrinsic value in businesses? If we do go into a recession, 20 million jobs were lost in April, which came out today. So I don't know what you want to call that, maybe worse than a recession. And then it's really the topic of, do all those companies hire back all those employees when everything gets back to quote unquote normal, whatever normal is. But how are you thinking about it?
Well, so it depends on the stock that we're looking at. I would say if we're looking at... So Buffett basically said that he thought Berkshire's intrinsic value relationship between price and intrinsic value wasn't that different now than it had been when Berkshire was almost, now that Berkshire's almost 20% lower than it was. So obviously he thought that it had declined in value by around that number. He said it wasn't a lot worse or a lot better, So the price and the intrinsic value declined similarly. So it depends on the business. I think there's some that we know have changed a lot. So oil has changed a lot. Banks, I would say, have changed a fair amount. That has to do with things like the yield curve and the credit losses that they'll have and all of that. And then for some other companies, they just shut down. As long as they don't have to raise money, then by diluting you, then you have just the few years of lost revenue, lost earnings that you would have had. So then you just have to take care of the factor of time there. If you're expecting a 10% return or something each year, and now you get nothing for the next 2 years, then obviously you need to factor in that, the values declined in terms of what you pay by, 1 divided by 1.2 or whatever. So that's basically how you have to figure it out is what have you lost? What's changed in the trajectory of the business versus what you had before? And then you just have to do the math on that.
Do you think that 12%, being 12% down on the year, I wonder how much of that is really because of the stocks that carry the market, right? The FANG stocks. Or like Amazon, Google, all those stocks make up X percentage of like the market, right?
Yeah.
Amazon is at its high, I believe. Google, I'm pretty sure, is done okay as well. All those stocks have, we could look it up right now if you are watching us on YouTube. So Facebook's at 209, talk about V-shaped bottom. It looks like it fell at 217, right? So it's up. We could go look at Goog. Let's see, year to date. Okay, so it looks like it had a peak of 1,526, and we're at 1,351. Let's see, Apple year to date looks like we had a peak at 324, so we're not that much lower, right? 301. Amazon feel like we're higher than where we were in February. So, I mean, if anything, COVID has actually probably strengthened Amazon's moat in their business. But I wonder how much of that 12%, is really just a correlation to those massive companies that continuously carry the market.
Sure. Yeah. And Microsoft is in that same category as a company that is big and isn't really presumably harmed that much by it. There are other, parts of the market. So smaller cap things and stuff. Those aren't really the kinds of things that we buy, though. So like when you see things like the Russell and stuff, that really has nothing to do with us. That tends to be very speculative kind of mid-cap,
more liquid
almost companies. Yeah. Then they're much bigger companies and they're much more speculative than what we invest in. So what we invest in is more like, we could look at some of them, like not the specifically things we own, but give you some examples. So a good example here would be, let's do MCEM, Monarch Cement.
Yeah.
So Monarch Cement, that's an easy one to do because we have just to ask is the cement demand for cement and stuff decreased a bunch. I don't know if these numbers are exactly up to date because unless they put out something recently, I believe that they should be a bit under, their price to book should be less than 1. So because that price looks lower to me than what their book was last I checked. But that's an example. So it is, so like for instance, Monarch Cement today is a bit cheaper than it was in like maybe 1997 or something like that if you go back. So, how different are times now from then? Short term, not as good, but in the longer term, it might be fine. So the stock did respond a bit to that. I don't, it was over 60, I believe, the stock, not long ago. So it does have a stock portfolio that's harmed somewhat by this because it's in home builders and energy stuff almost. So that definitely got hurt. But I'd say that's one that is kind of already reflecting a downturn in cement, and that's almost a later stage thing that we're not as sure about now. Advertising has declined a ton. That's probably why Google's affected compared to some of the other stocks, and we know that it's tremendous, the declines in that. But that could recover quickly. You've seen that in like if we look at let's look at Omnicom. Omnicom is a good example because this changes things a bit in terms of the intrinsic value, right? So Omnicom, I said it'd be really attractive to buy at like $45 a share or something, and that it seems like it must be worth at least $65 a share under any circumstances I can think of. The stock is a little bit cheaper, but it's at about 1 times EV to sales, and really price to sales, the leverage number is more useful here. So it's cheap, and you can see what happened in like 2008. This decline is worse, but it may not last as long. It depends on what people think about the recession. So they are reflecting it. But then you look at other companies. We've talked about Hilton Food, for instance.
Which isn't on here.
Yeah. And that's at an all-time high, basically. And so some of them are a little surprising. Some supermarkets are near highs and stuff. So I guess people feel they're not affected. I mean, Hilton Food is meat packing. It's heavily automated, but they may have some spread of the virus in their meat packing places and have to shut down. Sometimes it's hard to avoid that happening. So, there are things that aren't affected at all by it in terms of the stock.
How would you think about like valuation though? Like what, if you were doing just, let's say like back of the envelope type of valuations and you were going to slap a multiple on a business or whatever way you're going to think about it? I mean, how would you think about that today? Right? Like, or are you just more concerned about the certainty of the businesses being able to get back to 2019 levels and then paying that's cheap relative to that? I mean, what do you think?
That's one of the biggest things is just the easiest ways of asking is when would they be, take the trailing number. So let's say that you have full year 2019 numbers. When do you think they'll be back to that again? Do you think that, will 2020 be a clean year? Will 2021? Depends on the stock. For some stocks, it might be 2022. If that's the case and you lose 2 full years, let's say, or you use 1 full year or whatever, you have to factor in that opportunity cost that you're getting no return. Now, in some cases, people might think they're not getting no return. And that's why I mentioned Omnicom. Omnicom, if they want to, can keep buying back stock. So, that actually has a pretty high returning value for them if the stock's cheap. But for stocks that aren't buying back their stock, which is a lot of them, there's not a huge amount of benefit from the crisis, So I would say it's just a question of the amount of lost time that you have. as long as there's an insolvency issue. If there's a solvency issue, then you have a bigger problem because you have to factor in like whether you'll be diluted and by how much. But you can do that calculation. You can guess. I mean, you can say Dave & Buster's issued stock or whatever. You can say how much do I think they're going to issue and at what price and stuff like that. Guess ahead of time. That's basically what we talked about already with those. We said they'll need to recapitalize at some point. It's very hard to guess what the recapitalization will be done at because if they'd done it a month ago, right, they'd have a much worse deal than what they got instead.
But so when you're saying like lost time though, right? So that comes from like thinking about the potential IRR, right?
Yeah.
Because I was going to say, I mean, technically if you're paying a cheaper price though, aren't you already being compensated for that? Like, is it already adjusting for that?
Yeah. So actually the adjustment would have to be pretty big. So, I mean, it depends. We can do some of the math on it, but it depends. But the kinds of declines that we saw now wouldn't make much sense. In terms of the valuation change being big enough. So let's say it's 12%. You got a calculator here?
Sure.
All right. So as an example, let's say that you thought you were going to make 12% and you didn't.
Okay.
Then Buffett did this estimate before in the 1990s. He said, okay, well, you can buy Cisco or whatever, but since it doesn't earn anything, you have to add to the amount that you're paying what Cisco doesn't earn that you would have elsewhere. So in this case, we'll say that you were expecting a 10% return.
Okay.
That's what you hope for from a business normally. That could be a combination of free cash flow plus growth or whatever. So
Sure.
maybe at Google or Netflix or whatever, you're expecting to be mostly growth. So then you have 1.1, right? So you have 1.1 now.
Okay.
And then if that's just 1 year, now if it's 2 years, it compounds, and so you multiply by 1.1 again, you get 1.21, and so on, and it would be 1.33, I guess, in the next third year. So let's say 3 years. That's a simple one. 1.33. So there is a factor of time here that we can get into, but if you just take 1 and divide by 1.33, you should see what you should expect in the sort of decline that you would need to have, right? So to be able to buy something 3 years out, if you're assuming the earnings today, so if you assume for 3 years that it earns nothing and doesn't grow, okay, now that's different depending on the company. Some companies will take 3 years to grow back to where they were, but in the meantime, they'll continue to earn money.
Sure.
Some won't. Some will actually lose money, and so you have to add the losses into it too. So taking that into account, you should have a 25% decline if you have 3 years of not any earnings that you...
In the stock price.
Yeah, the stock price needs to be 25% lower for you to basically pay those 3 years. You're lending them 3 years of time. You need to get 25% cheaper stock if it's earning it today versus if it's earning it 3 years from now. Now, that's if you're expecting 10% type returns. The market may accept that returns are much lower than that, and I don't expect the market to return 10% a year for the next 3 years, really. I mean, I don't make predictions of that short a period of time, but it could be lower. And if it's a lot lower, then it makes sense, the kinds of levels that you might be at, like a 12% decline or something. And it depends on the stock. So you do it for the lost time factor. For companies that will lose money or recapitalize, you actually have to add the amount that will be lost to what we just did. So if you think it will take 3 years for an airline to get back, let's say, okay, it's not. So say the airline earns nothing and takes 3 years, then it would need to be down 25%. Now they're down much more than that, and the reason is you have to add in the amount of money that you basically have to be putting in. There's different ways of doing this, but the losses basically have to be added on top of that 1.33 number. So you add in those losses as it's sort of like a startup where it's burning money, and you factor that into it, and it's significant what it would be. So you can get to very big numbers that way, and that's why it's down so much probably, is because they're factoring that in. Those get tricky though, because of course you might have other people putting in money. So like with Buffett or something, he could have hoped, well, I won't put any more money in the airlines, but maybe other people will put in money at values that are too high for the stock, So you don't have to fund the losses yourself as if you owned 100% of it.
What would your discount rate be or your hurdle rate? Would you change that at all because your expectations for the market over the next 5 to 10 years is lower? Or would you still keep it at 10%? It's better to be conservative.
The truth is that in general, as the expected return on the market goes lower, it increases the option value of money, so that actually you might want your discount rate to be higher because the value of inaction goes up. So in essence, when the market's likely to return very low numbers is usually right before it's about to return very high numbers. So like in 2007 or something, we might have expected to return fairly low numbers, or 2000, but then within 1, 2, 3 years, depending on which case, you had very good chances to earn 15% instead of 10% or whatever. So it's hard to say. I mean, that's one we've talked about a lot before. People tend to use they put in interest rates and things like that. I would say, it's up to you and what you can do. The best thing is if you know of an alternative that you are confident will get a certain return. We can do that mostly because we own some stuff that's unrelated to the market. But people could do that with a bond, a preferred stock, whatever that they feel confident in. It doesn't have to be a government bond necessarily.
Would you pay today 15 times, let's call it 2023 earnings for a solvent, good, predictable business?
Yeah.
Okay. I'm just trying to see what you're thinking of valuation multiples and stuff like that.
Oh, you mean would I pay today for 15 times earnings in that far in the future?
Yeah.
No.
Okay.
No.
So what would you pay today for a good business then?
You mean if the business won't produce earnings for a few years?
Sure. We could do it like that. Either way. Yeah. I mean, that's how a lot of people value stuff, right? They slap multiples on it. Okay. If you're going to do a back of the envelope, I'm just trying to give people how you're thinking about, multiples and valuation in this environment, assuming that we have some sort of recession or something like that going forward. You said the other day that you are the bearish that you've ever been, yet we're still looking to purchase stocks, obviously, and we still have purchased equities.
We did purchase equities, but it was at 4 or 5 times last year's earnings.
Yeah.
So if earnings drop 50%, we're still purchasing at a pretty big discount to what most people are paying. If they drop 75%, we're still paying a pretty reasonable price. I would definitely buy stocks like that, single digit PEs and things and discounts to price to book. I'd be very interested. To answer your question, you probably pay about 2/3 of the value that you normally would. So if you like stocks at 15 times earnings normally, then you need to pay about 10 times 2023 earnings. Yeah.
I thought it was interesting in the Berkshire meeting how Buffett was saying he didn't view their stock as technically cheap, even though it's cheaper than when they last repurchased the stock because of just everything that's been going on.
Yes. And I think it was mostly intrinsic value, but he did explicitly mention the option value of cash. And that is very significant. There's not a lot of cash in the world that isn't also have borrowing associated with it now. A lot of companies have taken on debt. There's not a willingness by a lot of companies to use up their cash, Let's put it that way. We own stock in NACO and they said that they'd like to purchase some mineral rights and stuff. There's probably not a lot of companies that are looking to take cash and buy mineral rights right now. So, obviously if you do that, then the value it's more attractive. You could probably get a little more mineral rights than normal for your cash.
You been following the price of natural gas lately?
I have not been following the price of natural gas.
We talked about it today on the rundown with Vetla because it's been skyrocketing.
Yeah.
So I thought about NACO or whatever. So what would your advice be then to individuals? People reach out to you all the time, talk about valuations, everything that's going on in the market, the potential recession. How would you think about what would your advice be to individuals buying stock today?
My advice would be to look out several years. I like to look out 5 years. I like to look at longer than that when thinking about a company, but look out 5 years instead of looking at today's PE and try to figure out if you can find a company where you feel confident what the PE will be in about 5 years. And then it's worth it to buy now for that. So we have a stock up on the screen right now, Omnicom, where obviously that's not a bad PE, or price to sales, for instance. Like that price to sales in 2008, I was happy to pay. The business isn't quite as good now as back then. But I would say try to find something that you can look at 5 years. That's obviously what we did with the stock we were talking about as a car dealer. Obviously, I think that in 5 years, car dealers will be an okay business. The reason why I mentioned Monarch Cement is because I think in 5 years, cement will be an okay business. Now, if you're in some sort of huge depression or something, then demand for cars and cement and homes and all sorts of things will be a lot worse. But these are things where we can figure out that we hope they won't actually burn a lot of cash for a few years. They have some cash on hand and some borrowing ability. And then we just say, what will they be priced at 5 years from now? That sort of thing. So can you afford to not grow for 5 years or something? And you can. If you pay 4 times earnings or even 8 times earnings, then you can afford to not grow for that long. Like I said, it could be 10. You could be okay with that. So if you pay a price today that you don't get back to till 2023, and that price is 10 times earnings, you'll be okay, because if it trades
Okay.
at 15 times earnings that many years from now, you'll do fine.
Be compensated
You
for
won't. You won't make meaningful amounts of money in the stock, but as long as you're paying prices that are like 10 times those future earnings, then you're fine. If you're paying 15 times those earnings, though, you have to be careful, because that is, if it really takes them several years to get back to where they are now, paying 15 times last year's earnings is going to be a lot like paying 25 times earnings when you factor in the amount of time that you've lost, you know, as opposed to going out and buying something that immediately has yield.
Perfect. Yeah, that's actually what I was trying to get from you. Well, great. Well, I want to thank everybody so much for tuning with Geoff and myself in today's podcast on the number one value investing podcast in the world, soon to be the number one value investing YouTube channel in the world as well. Hit that subscribe button, thumbs this video up. We have a lot of momentum there. I'm loving it. I am absolutely loving it. It's making it more encouraging to put out content.
Yeah.
It's fun.
Yeah.
It is fun. So, and if you're listening on the podcast side, anything, a rating and review goes a long way. If you like Quick FS, which is what Geoff and I use, I don't want to plug this too much every video, and you want to sign up for it, if you mention that you heard about it through us, there'll be a survey, and you could click Focus Compounding. We get a piece of your subscription price, which is a good way to support us if you like the work and the content that we are putting out for everybody for free. I want to thank everybody so much for tuning in with us, and we will see you in the next podcast. Take care.